I am Puneet Khurana with my very good friend Manish Thawan, and together we bring you Stoic Podcast Series. This series is started as an initiative by StoicInvesting.com to bring the best minds of investing to teach their wisdom, irrespective of their investment style or philosophy. Learn the various viewpoints, choose the nuggets, and then develop or enhance your own investing style.
Hi listeners, welcome back to the Stoic Podcast Series. I always believe that there are two types of people in our financial services, specifically the investing industry. One, who have no or little experience of outperformance. And that outperformance period also comes during the bull market. As Buffett would have called them, the naked swimmers in the high tide. And not surprisingly, you will always find these naked high tide swimmers harping about their skill set and their geniuses, ignoring the role of randomness and luck in the process. There is a second breed, however, who will consistently outperform across the market cycles, but will consistently underplay the skill component in the luck versus skill debate. Among this rare second breed, there is an even rarer subsection that is brutally honest in their approach to investing and life. And their answers generally reflect the same. Today, we have a guest who belongs to this rarer of the breed. Anoop Bhaskar, an award-winning mutual fund manager who is extremely candid and equally talented. We met for the podcast post our meeting at the Howard Marks event in Mumbai. And it was no surprise to me to see Anoop present there, as he is a big Howard Marks fan, from whom he has learned to appreciate and manage risks. This and many more conversations and the truth about the mutual fund industry from both the sides of the debate is what follows in my conversation with him. I also have Nuresh Mirani as my co-host during the podcast. Nuresh and I loved our conversation with Anoop, and we hope you enjoy it too. Let's listen in. Welcome to the Stoic Investing Podcast. Your career path has been interesting to say the least. So you started with Kothari, if I'm not wrong, in the mutual fund industry. And from there you went on. Kothari was acquired by Franklin. From Franklin to Sundaram, then to UTI, and then to IDFC Mutual Fund. Okay, first question is, what has changed in terms of your working, philosophy, or anything else? And what has not changed? So what have been the consistent factors in your working? From Kothari to IDFC.
No, Kothari, I was an analyst for almost 10.5 years.
Okay.
So from that point of view, decision making was not in my hand. And since Sundaram, I've been a decision maker and also managing a team. So it's a bit of a progression after a very flat career.
But 10 years as an analyst, that is something very unthinkable nowadays, isn't it?
So that is the bear market of the 90s. So I keep saying that I am a child of the bear market. So I think there were very few opportunities. And even in 2003, I think our largest fund was 1,500 crores in size, which is a blue chip fund. So the market took a long time to explode.
But when it exploded, you were in Sundaram.
Yeah. So 2003, I moved to Sundaram because I wanted to try managing a mid-cap fund.
Okay.
And it was, as Howard Marks says, if you are aggressive and right timing, you don't need much skill to do well. So, so that was, I mean, if I had joined 2 years earlier, I would have probably has been in the market because the earlier 2 years were quite difficult.
This you mean 2001 to
2001 to 2000, yeah. 2001, 2002 actually were not very difficult. They were very interesting in a way that in 2002, if I'm not mistaken, Primer Fund NAV went up 3 times in 1 year.
Wow. And
the overall market fell. So there was this huge move which had happened in mid and small caps. And the broad market as represented by Nifty just did not register anything. So that way, if you were managing a large cap fund in 2001-2, it would have been really painful. But managing a mid cap fund would have been fairly interesting. So I think the 2003 was a blessing. So my first purchase was Blue Dart at 70 rupees in the fund. I bought 1% of the fund at 70 rupees. Of course,
70.
70.
And it went on to what, 16, 17?
I think so.
2,000 bucks.
Yeah, 2,000 bucks.
2,000
Yes.
bucks.
So
you sold it
yeah.
in the middle?
I generally, my thought process was that we would not allow the stock to go beyond a certain percentage of the portfolio rather than take an absolute call on exiting.
Okay. So
because
the exit is not based on valuation, if that's what you're saying?
It could be triggered by valuation,
yeah,
but it would be more based on what weight the stock would have in the portfolio.
Okay.
Rather than just an absolute call on valuation, because things can remain too expensive for too long and prove you wrong. So one way out in your portfolio is to keep the weight pegged to a certain level,
okay,
and keep trimming the stock whenever it goes up, rather than taking an absolute call to exit, because now it's at a very high elevated level.
I have certain very specific questions regarding your process, but I'll come to that. So let me first hover around the point that you, at the end of the day, have spent majority of your career with mutual funds. All of your career, in fact, with mutual funds.
3 years before that were with.
Okay. Besides that, everything has been mutual fund. And Buffett has been let's say, argument against the institutional imperative and what people have to do when they are in institutions. My question is, first of all, and there is no hiding institutional imperatives. The institutional imperatives are there. What all things you can differentiate yourself on as a fund manager, and what all things you can't differentiate on, even if as an individual you may be very different from other fund managers? What are those things where you cannot do much about? So those strong institutional imperatives.
See, institutional imperatives are only meant to make you more sensible to not take career risk decisions.
Okay.
And there also are a product of the kind of environment in which you operate. So if a company believes that mistakes are made as part of the process and are not to be investigated with a vengeance, then there is very little career risk if you go wrong on a stock, however colorful it may be. So a lot of it depends on the environment and how the company views the investment philosophy or the way of, because we do not deal with exact information and we don't know how the future will unfold, and we are not forensic investors. I'm not saying we should not look at accounts, but our job is only to do a cursory level investigation to see whether operating cash flow is positive, whether debt is being repaid. We can't go into the veracity of accounts because we don't have the access, nor do we have the time. We are not a private equity investor who's taking a board seat and therefore is going to be in marriage for a long time. For us, the option is always to exit if we make a mistake. So in these with this framework, I think so, it delves more on the environment and perception of that environment for you to decide what is your Lakshman Rekha and what is not. So in Sundaram, I have bought a Unitech and I have also bought a Lok housing. People remember Unitech, they forgot about Lok housing. But nobody in Sundaram would have questioned why I got Lok housing wrong. And that is a very important part of the environment that you want to be in. So if you are in an environment where you believe that if you make a mistake and you will be hung for it, why would you then take the risk? So I think that's the point. Any institution which is backward looking and procedure driven will always stifle risk taking, because you will not be rewarded for the risk working out, but you could be punished for the risk failing.
Do you think one of the big reason is that most of the fund management side, most of the people, they don't really put their own money into the funds? It keeps it away so you can take those bold calls. So skin in the game concept which we were discussing.
See, first of all, I think Warren Buffett is the wrong example.
Fair enough. Yeah.
I think so. He's the most misunderstood investor of all times.
Fair
used by people for exactly the wrong reasons context, and just to justify everything.
And just to quote him over first time.
Yeah. So it sounds very intelligent to be a Warren Buffett. Yeah. So there is this, if you are a value investor, it is how many times you've been to Berkshire Hathaway annual general meeting is the badge of honor that you have in India as a value investor. And then people buy, we know all. So first of all, that is not, so this skin in the game is a very different perspective. I think so more than that, you should have a head on your shoulder, which should have a risk understanding. And it is imperative that within the institution and outside the institution, a more holistic way is used to measure a fund manager's success. Unfortunately, in any measurement of fund manager, the trailing performance has got such a high weight that any other parameter really doesn't. So it's like the clouds in a sunny day, they really don't matter. And performance is like the sun. So if it is blazing high, everything else is just disappearing. So to come back, I think so, skin in the game, I think so, more than that, there have to be risk parameters which should be evaluated. There should be a consistency in defining investment philosophy and sticking to it, rather than forcing a fund manager to have a very high skin in the game.
So, is this another reason that highlighting of successes as well as the mistakes by the media, as well as the investors, as well as the investment committee, which blocks a fund manager from taking calls which he would rather take it if there were not this imperatives of answering out mistakes?
See, it's a very thin line between being brave and being foolhardy. And I think that's where it is the head on the shoulder that matters most, on how you define your risk appetite as well as that of the institution. And I think that is something which, say for lack of word, the superiors to a fund manager who are non-fund management oriented do not appreciate. So if the guiding star for measuring a fund manager is only performance, then I think the fund managers will do what is required to get that. So, which is where I think so, I am not very critical about the industry, but this is the first generation of our industry. Even in the US, if you went in the 1940s or 50s, fund houses did not have an investment philosophy or a thought process or style. So as the industry matures and as the participants mature, we will be a more mature industry. So today, which fund manager would openly say that their style of investing is closer to momentum based? Everyone is a long-term, high-quality, great capital allocation, great corporate governance model, which is fine. I am not saying one should not have these criteria, but nobody wants to hear the other thing. That, and I think it's a great skill to have. That if you say that I'll do very well in a bull market, and if you believe the markets are bullish, why wouldn't you give more money to a fund manager who's got a track record to do well in a bull market?
Right.
But we have not yet reached that level of maturity.
In terms of clientele to understand?
Yes.
Okay.
So the stakeholders involved are all...
I mean, you mean stakeholders, you also mean the investment committees and...
the distributors, the customers. So in India, the rule of diversification is to get the top fund from 5 categories and not 5 different thought processes.
Right.
So...
let me on that only just ask you a question that you said investment philosophy and risk, the two things which you mentioned, and you also mentioned head on the shoulder has been the major strength for any good fund manager. First of all, investment philosophy is driven by the fund manager, or is it driven by the institution where the fund manager is lying?
See, there are very few pure fund management companies left worldwide, leave alone in India.
Yeah.
Most of them are offshoots or have been acquired by a large or are part of a large financial services group.
Yeah.
So to say that overseas there are several companies, fund management companies, which have an investment philosophy is an oxymoron. I think so. This is a business of gathering assets and trying to be popular in all seasons with some offering or the other.
Right.
So it all then boils down to the scheme. What one can see very perceptibly, even in a first generation market like India, that there are a few fund houses where the overarching theme might be to buy less expensive stocks. But that would not be for all the stocks in the portfolio, but overall you would find that there would be fund houses. But most others are only trying to perform.
Yeah.
Which means whatever is the flavor of the period is the one which...
And that will be common across the mutual fund. Why I ask this is because mutual funds, and I'm sorry to do this, but again, I will have to quote people from the outside only, and within India also, people beyond the mutual fund industry are very critical of mutual funds as a unit. And the reason is that their point of view is that mutual fund is like banking, which is a Me Too kind of industry, and almost everybody is trying to do the same thing and trying to replicate the same thing, primarily because there's a career risk involved. So if you take the risk of, let's say an example, for example, that a particular company in Nifty, and I don't want to name, but a particular company in Nifty is, everybody is, underweight on that thing, and that thing all of a sudden goes up. If everybody is changing the point of view, one fund manager might be taking a huge risk by not changing his point of view, even though he doesn't believe in the whole company story. So that, again, the cliche of herd mentality is so persistent that it becomes absolutely difficult for a fund manager to differentiate him on.
So let's look at it from a different perspective. We offer, probably at one of the lowest cost, the chance for an investor to do without any perceptible hard work to participate in the economic wealth of this country. And the cost is fairly low by any standard. Now, where the cost goes, I will not get into that part. But for an investor, from an investor point of view, if you were to come as a direct investor, you're probably use the services of whatever is available from the available talent pool, the best of the talent, at less than 100 bips per year. If you come to the direct pool, there is no fund which charges more than 100 bips direct. And for what work? And the average fund has still beaten the market and has given fairly decent return above inflation, even with a herding mentality, even without any investment philosophy, because that is how India's wealth has got generated, and Indian economic growth has created so much wealth that they have been able to partake in that process. So I think so, again, coming from Howard Marks yesterday, if the trend line is steep enough, it's a question of how long you stay rather than anything else. So I think so, at a very low cost, in a very regulated environment with liquidity on tap, investors have access. So I would not be too critical from that point of view, that we are providing a service which still has given fairly comfortable returns to most investors if they had stayed put for a longer period of time. And for the more sophisticated investor, there are more sophisticated routes available. But in any market, the base load in a plane, the economy class pays for the fuel and business class pays for the profit. So same way for a mutual fund is the same issue that is there, that we are providing for most investors who have never invested in equities or who don't want to spend time understanding equities, a route which is fairly cheap, which is well regulated, which offers liquidity. And that should be the service that we should focus on rather than whether our investment style, philosophy, that is the next level.
Yeah, so there is another, element which a lot of investors, those who are not pro mutual funds, actually says a fund manager can trade his way out without getting taxed. So, for example, the structure in India allows the end investors to take the long-term capital gains, irrespective of how much is the churn by the mutual fund manager, who can take all the flavors of the season and still not get. So, is that a big advantage you have as a structural product? Say other products, say a hedge fund may not have so, or a PMS in India doesn't have so.
That's their problem. Why should I worry about the problems others face? I am not here to democratize. See, for investors, the tax treatment of mutual fund should make it even more attractive to be in it. Except because we are trying to make it very uniformly lowest denominator. It doesn't excite people who expect higher service or, a higher meaning. In the end, there are 400 investable stocks in India. So whether you go through a PMS where you pay 200 bips and 20% or whatever is the profit, or you pay 100 bips as direct stocks, to wahi khareedna. It's not that they have got a different market to play in which is not accessible to us, or we have a market which is not. So I think so for investors that has been a greater advantage, that mutual fund. But I think so you'll find most good funds have got a portfolio turnover of less than 50%, which means they hold on to investment at least for 2 years. So nobody does trading in a demonic or a maniacal way where you have portfolio turnovers of 500-600%, where what you are saying would be an added advantage, which is not the case. You can see most funds would probably have 5 or 10% of their portfolio if ever on derivatives, or which might be traded more actively. But all those numbers, because of the regulator, are printed every month, every quarter, every year. So you can see that that's certainly not an advantage, which of course a lot of PMS guys and other investors claim as a disadvantage for them. But then life is not fair.
So over the years, what was your critical turning point in terms of understanding risk? So when we speak to a lot of fund managers, somebody says 2008 was, somebody says 2001 was, in terms of defining the own investment style or the putting the head of shoulders in a much better way. So what was your changing point in your...
So I was being with a mutual fund from 93, even though the first 10-11 years were as an analyst, seeing from close what a fund, how a fund can get impacted. And if you are a learner, you will learn from those experiences. So Kothari Pioneer Blue Chip was actually a closed-end fund, and we all thought we were cat's whiskers. So there used to be a discount for the listed stock units to the NAV, and we thought, the traditional thought process that you buy the discount. In the last year was the first year of the bear market. The NAV itself fell from 15 to 11. So for trying to get a 10% discount, we lost 40% capital. So I think these are the things that over time when you observe, and what you imbibe from that is what you build in your system. So one was, don't have very high concentration, which again goes against one of the beloved concepts of Warren Buffett. Focus on liquidity in a portfolio. Keep trimming profits so that you don't have one or few stocks which drive your gains. Again, it comes from either you should have a very strong framework which the institution has developed, which would not be the case in India because we are a first generation industry, which some of the foreign houses can claim to have had. Or you then build it from experience and say this is how you want to operate.
Okay, so let's do one thing. Let's go in the specific of that. So what is your investment framework? And within investment processes, from the selection to the selling to the portfolio management, let's go one by one into a bit more specifics now. So first of all, if you have to define your philosophy in, let's say, a few words, what will be your philosophy or framework of operation?
Philosophy is for big guys like Howard Marks. So investment framework is, I think it depends on the kind of fund you are managing. If you're managing a diversified fund, which is large mid-cap oriented, then you first understand your benchmark.
Right.
So usually we take BSE 200 because we think so it's a fair mix of large and mid.
Okay.
And then you do your sector allocations based on your thought process for the next 6 months, 1 year, valuations, and then decide to do. And as a risk parameter, you decide how much overweight or underweight that you would be BSE 200. And I think so
Compared
over
to BSE
time,
200. Okay.
I have realized that running a fund which has most sectors in it, even if you don't like it, is far better rather than taking absolute calls on just selecting a few sectors. And the problem in India is that any index, 30% or roughly is financials. So I keep getting amazed at people who are bottom up, but when you see their sectoral allocation, it's around 31% in financial always consistently. So, how can a bottom up fund manager end up with 31% financial consistently is a skill set that Indian mutual fund industry has clearly demonstrated on a real-time basis.
Right.
So I think if you go to 30% in a single sector, then you are not really a truly diversified fund. And that's where the problem comes, is that in my previous organization, my big-headedness, we said that you can't go beyond 26-27% in financial and generate alpha out of other sectors. While it helped us in down markets, we would always get impacted severely in an up market, and money comes only in an up market. So prudence, as Mr. Howard Marks says, is most revered in a bear market and least in a bull market. So I think that is something that I have realized. So I think so in India, the first thing you require is to have pragmatism in your investment thought process, which is that if the market is 31% financials, you be 31% financials and then decide your stocks, which could be different from the benchmark rather than, because it's a segment which has got the highest beta, it's got the highest weight. Being underweight is a career risk that you carry consistently.
Sure. So your selection is going to be you will benchmark against you will take the benchmark, you will have to vary the stocks depending on your viewpoint on a particular sector.
So my view is that there are two moving parts in a portfolio construction for a diversified fund. One is sector allocation, one is stock selection. So freeze the sector allocation by putting overriding.
What do you look for in your sector allocation criteria?
So don't go overweight more than 500 bips for a sector which has got a weight of more than 10%. Sector weight which has got below 10% benchmark weight. Don't be overweight by more than 300 bips. Don't be also same way in terms of underweight. So even if you don't like a sector, you still should have it in your portfolio. Classical case is IT. August, September last year nobody liked IT. November, December everyone was tripping to get into IT. So if you limit your underweight to a level where you don't have to have very dramatic moves in and out, you can then and get your alpha generation out of the stocks and not out of your sector selection.
Okay. So what I'll do is I was thinking of doing it later, but I'll do it side by side. So let's keep yourself in the shoes of fund manager also. And then let's imagine that if you're not managing fund and you are an individual investor, or let's say...
I can't do that because I've been a fund manager now for too long to take.
Okay, so let me put it this way, that if you have to, if an individual investor comes to you and asks for guidance, you are going to take the benchmark as your guiding criteria to start with, because it's for the diversified fund, because you have managing a diversified fund. But if you were an individual investor, or you have to tell some individual investor, what is going to be the criteria then? Are you still going to say and assume diversified? Let's not go into the concentrated part of it. So will you still advise him to go into the sectors where you are not comfortable with in either a cyclical way or whatever way, just for the sake of diversification? Do you think that's a good add-on, or it's something you will advise against?
See, let me answer it in a different way. To have a fund which is benchmark agnostic, you should be first open to the idea that it will underperform for a significant period of time if you get your stock calls wrong, and it will also outperform for significantly long periods of time. So its tracking error will be very high. I don't know temperament wise how many investors are built for that. So it can be used as a complementary product.
What does that mean?
You can put part of your allocation for a fund which is totally different from others. And put a large part of your allocation which is something that you will at least get benchmark plus return. So I think one of the things which I rail against a lot is that being a closet indexer requires more skill than being a outside benchmark go anywhere fund manager. Believe me, if your choice is only 100 stocks from where to beat the index, it's far more difficult if your choice is 700 stocks to beat the index. So first of all, we should not be defensive if someone says that this style is closer to a closet indexer. I would challenge anyone from the 50 stocks in the Nifty to keep beating Nifty consistently. It's not as easy as it appears. But we all run funds which are diversified, which means, and again, most alpha is small cap, and that's where alpha is generated. So you need to give assurance to an average investor or a first-time investor of the names which are there in the portfolio and how the portfolio will behave versus the market, and generate alpha out of the names that he is not aware of. And that's what diversified funds are meant to do. That they're meant to introduce volatility to an investor and make him prepared to go to the next level, which is to go and buy a pure mid-cap fund.
Okay.
And that's the way I look at the journey of how funds should be sold and positioned for investors.
So are you saying that investors, a new time investor should not be pitched a mid-cap or a small-cap fund unless and until he's comfortable with the volatility of it, or he's aware of it at a psychological level?
Yeah. So I think how does he get aware is when he experiences it. It's fine. You don't experience it when you're shown a sheet. You experience it when you put your money and then you say, this year I have not made return, but last year I made very high returns, and next year when I made very high returns, I want to make even more, so I'll take a higher risk because now I'm used to. So I think that's how the general progression of investors should be, is that you get diversified funds as the first step to come in. Then you go to mid caps, and then you get more, then you get into sectors because you become more informed and you are willing to take calls on which sectors or which themes will play out. And that's the way the progression of investor should be. Unfortunately, progression of investor is by returns of which segment have been the highest rather than through this route.
Okay, so let's now go to the next step, which is, so after you have decided that you have to change the allocation in that sectoral allocations, what is your selection criteria? You go from industry to companies. So you obviously have to take a call as to which industry you want to overweigh on and which industry you want to be underweight on.
So I think there is no one way. It could be a combination of factors: valuation, growth opportunities. It could be susceptibility to any macro factor which a sector is more susceptible to in the near term.
Can we take an example from, let's say, not the current example, but let's say in the previous when you have taken, or let's do one thing. You have been, you have taken calls in real estate at a time when,
I can't do an interview without talking of real estate, it looks like. So.
Because, that's Unitech, as you just said. Unitech people remember, so we remember that.
So, I'll give you the genesis of Unitech was that at that point of time, when I was running that fund, we did not have any banking sector exposure for two reasons. One was that I didn't understand banks, and B, I thought banks are a factor of scale. So if you wanted to play real estate, I couldn't buy HDFC because HDFC was part of the Nifty.
Okay.
And there was no other housing finance company, I thought, which was I could have taken a bet on. And the most unloved, unwanted, and undervalued sector was the real estate company because of their past colorful history. So you needed to be a little bit naive, foolhardy, brave. And we didn't make money on it for a year. So it's not that we bought the stock and it went up. So for a year, which is where in a 600 crore fund, if you buy 6 crores worth of Unitech, you don't have to worry every day on what it does. So that was it was an option value, and we made sure that we never let it cross 5% of the fund. So when even the fund went to 2,800 crores and Unitech went to whatever, it was not more than 5% of the fund at any point of time, and we sold out of it completely. And I think that was the thought process, that there was no other way to play the real estate boom.
No, but my point is, real estate boom is a foresight, or is it's an assumption?
No, it was what was happening at that point of time. It was what was happening at that point of time. Gurgaon was developing, rates were going up, banks were showing, housing finance companies were showing.
But then why was it that not many people were in real estate sector? Is it because of the past, you're saying?
I think so. Just the colorful history attached to these, and they were not Mumbai based, frankly. And the industry is very Mumbai centric. So if Unitech was Mumbai based, I'm sure some other fund manager would have discovered it much earlier than me. There were no listed Mumbai based real estate players at that point of time, if I'm not mistaken. Which is why the Mumbai fund managers missed out on it. Not that it helped us. We were in Chennai, but I was from Delhi, so
you were working in Delhi only that time?
No, I was working in Chennai. So I had been in Chennai for 12-13 years, even before that.
Being a Delhiite, that would have been very difficult.
So again, I'm saying the further you are away, the less watts you see. So the superstar that you idolize looks most beautiful in a picture rather than in reality when you interact. So same way with but they had 1,200 crores of advances from customers and they had 1,100 crore market cap. You just had to open the balance sheet once to see that number that they could fund their growth so that was the advances they had taken for business which had to be booked by them and they would get some profit out of it.
So if I have to take one, let's say a key lesson or something like that, you have been quoting Howard Marks, so let me just quote once more. He said that you have to be contrarian and you have to be right. Okay. And in the real estate theme, that pretty much worked out the same way. You were contrarian because nobody was betting on the past history of the promoters or whatever the colorful history. But it went on to be a right call. The question of being right is where my next question is. That in one of your previous interviews, I have said I was reading is that you said that foresight is something which is over. It's something which it's over harped on, but it's very limited. It's available in a very limited quantity per se. How do you get that contrarian part? I understand you can look for industries which are in dumps and all.
See, I'll give you a very simple example. If I was really a foreseer of future and if Unitech was not a fluke, then I should not have missed the building material boom of 2010 to 2014.
But you can't foresee everything, but you can have
So it's very difficult to... But I'm just saying, again, my point is that it is very difficult to get it right and to take big bets on it. So let me rephrase it. Let me rethink what I just said. I think so. It's very difficult to repeat what people give you credit for of seeing the future repeatedly, even in the same sector. So there's an element of randomness, if not luck, in your ability to do that, and one should be at least humble enough to accept that.
But if it's happening frequently, you will give skill the more weightage.
Then you should not be a fund manager working for others. Then you should be managing your own money, trying to become the next Rakesh Jhunjhunwala with leverage. Why would, unless you have genes of Mother Teresa in you, where you want to do it for the larger good of people. But if you're so good that you can spot you yourself will. So, this is something which someone told me. In 2002, I was a very frustrated person that I had been an analyst for 10, 11 years. I didn't see any. Markets had tanked after 2000. We were at the bottom. So I met someone in Mumbai who's a very good investor, and he might not remember. So he was just quitting his job to join a fund, and he said, Anoop, there is one thing about financial sector market you should remember, that salary and money will always find talent. So you don't have to look for either of them. If you have them, then they will. That point of time I didn't understand because neither was my salary very high nor was my talent very well known. But I have realized that I think so, if you do well as a fund manager and as long as that is a public track record, you will get money to manage. People will find, because making money is a very scarce art, which even if you're living in Timbuktu and speaking Swahili or whatever is the language there, people will find a way to come to you and give you money to manage. If you had a alchemy to convert money into gold. So, but it takes you a lot of time to realize, and when you are in it, you don't really appreciate it. But over time, I have realized that, which is what my advice to my peers or my colleagues is, that when you start a fund, when you start managing a fund, you may take a longer time because you are not known, but it will be very... You have to be really, unlucky that if you have 3 years of quartile 1 performance, that your fund will not be a few thousand crores today. So again, I'm saying performance gets rewarded by AUM in this business as long as you have a creditable
track record,
public track record, which people can track. So you don't know when somebody in Norway wakes up and looks at a fund which has done well over 10 years and gives you money to manage.
So, again, taking something from your previous interviews and again coming back to the investment framework of stock selection or industry selection and then stock selection. And somewhere I was reading that meeting management is one of your way to judge whether the business cycle is turning or not. Can you just take me through, first of all, are you a quant data-based business cycle finder? Let me put it this way. Or you are like, okay, there is this whole gamut of industries. I keep on tracking them for a long period of time, so I get a sense. And then I start focusing on where I think the business cycle is. Which are the two?
So I think so, which is again what I tell my colleagues, is that in your first 10, 12 years, the more number of companies you meet and keep notes on is probably the library of knowledge that you build for yourself for future. And I wish I could graduate to a very quant-based system rather than a very intuitive-based system, which requires you to interact with managements to figure out who's doing well, not. So our meetings never focus on earnings or the
Sure.
Our meetings usually focus on the environment in which they operate, which markets are doing well, bad, why are they doing well, how are their suppliers behaving, how do they behave with the suppliers, how are their competitors behaving. And I think we are the patsies who go before a quarter and never know the next quarter numbers. So because that to me is not my job to ask, and I should not cross that line. But that gives you a perspective on the broader business, and from that you get leads. So it's a very intuitive. Unfortunately, you can't call it a very systematic way.
But I'm slightly curious. You said, and I'm just speaking on words, I could be wrong, but you said that you would want to be quantitative driven. Do you think, first of all, it's possible?
So I would think that at some point of time, so for example, why shouldn't a fund manager buy a profitable company trading below one-time book and not worry about valuations or where the industry is or how, until as the earnings itself are so if you have a company which has got a fairly regular track record of dividend paying, trades at less than one-time book, why should you be worried of which industry it is in? But I don't have that confidence because I've experienced it. It's very nice to say in theory. So Apollo Tyres is a great example of a company, profitable company trading at one-time book, but has not made any money for the last 3-4 years because the baggage about the company is far more than what it has delivered. And I think so to come to that system, it is better to do it in your personal capacity where you are not being judged on a relative basis on very short-term periods. But as a fund manager, not every company will turn out to be like this one. So as a practice, if you find companies which are profit-making, dividend-paying, trading at less than one-time book after you adjust the book for any issues of being overinflated because of goodwill or others, it should be a very standard way to look at a stock to buy.
So are you saying because your starting point is index-based, that is why you can't do that? Or
no, not my starting base, because we are in a rat race where our trailing 12-month performance is fairly important to be relevant, and especially when you are restarting in a new company, you don't want to saddle your portfolio with such high concept but unknown future movement portfolio. So you would actually start building some part of your portfolio as your fund gets more stable performance, as it becomes a quartile 2 from. See, it's also relative. You can't take a too long-term a view when your fund is 4th quartile. Then it's really a career risk. Then the guy who comes after you will probably be the smart guy who gets the benefit of whatever you did. So you have to mix and match depending on where you are. So I was reading a very interesting article which I should have read years back, but I read it now, where he said that one should look at your top holdings from a next year perspective and not this year, because you know how bad you are this year. You should be worried about what will bring you down next year and try to rectify that. And I think that's something which I'm trying to think more on. So it's the ideal way, and unlike a doctor, you can't have a checklist of having 17 points which you tick mark against and then say this is a buy, sell or a hold, because we don't have that luxury in investing. But at some stage, for a retail investor who's not being judged on a daily basis or on a short-term basis, that could be a very good way to invest for long term, because the returns would be fairly similar to what you would get from what we do, but it would have long periods of very high tracking error.
So, like what you mentioned is in terms of management meetings, you try to understand the industry from the managements. A lot of people actually believe in going to the industry and then trying to understand the management through scuttlebutt. And so a lot of people basically go to the unlisted players or vendors and suppliers and then try to get a hang, or you go the other way around. So,
see, most public listed fund managers are fairly lazy. They only go for meetings which they can get. So we are not private equity investors whose job is to meet 500 companies a year and then keep doing this. So I don't know. I know it's a mythical statement that a lot of fund managers meet unlisted players, but I want to know who are the guys who fix the meetings for them, because I'm sure I get the same. I would have the same guys giving the invite to me as well. What it can help is if you are part of a large industrial group which has got business in similar industry, that you can get an informal perspective which is very different from, but believe me, that is just theoretical. Nobody gives you time, even if you're in a large group or even if you're part of an international group, to spend 2 hours with them to understand, unless you have some access through your boss, or your boss has built some social network within the... So I think a lot of it is done when you don't have pressure of daily performance. So again, retail investors or private investors who run a very different portfolio can do this. It's very rare to find a public listed portfolio manager who can say that I spend 20% of my time meeting unlisted companies to understand the industry and getting a perspective from them. We just don't have the access and we don't have the time, frankly.
So, has there been any instance where you just believe the management? Because many a times people have taken a call on belief rather than data. So, has there been some cases where you just took a bet on the management and forsaking the data which is available as of now?
See, management comfort comes with duration, time and the amount of money they made you. So, it doesn't come from the first meeting. So, I am not among those fund managers who on one meeting would have put in 100 crores in a stock because they like that management. That's not my risk-taking style. If I would have invested 100 crores in a stock, it would have taken probably 2 years and some 5-6 meetings and at least 50% up on the original investment for me to go to that level. So, I again,
In one way, are you saying that you judge the management quality by the price? I know it's not. Yeah, I'm just saying it's...
No, I'm just saying your comfort comes from what they say.
But when you say you're not talking about the price, you're talking about the earnings.
I'm just saying both.
Okay.
What are the deliverables that they have actually achieved from versus... See, one reason why in Asia we are a country which has got the highest P's, because we are all good talkers who speak English, who say the right things. You show me how many managements today don't talk about capital allocation, ROC, which is what and if you are a foreigner who's come from Boston and who thinks India is a country where probably nobody would have heard of ROC, and he meets a management and he gets bowled over, and then they go and do some 4 acquisitions with 6% IRR. That's where people get disappointed. But I'm saying it's a management meeting is like your courtship in a arranged marriage. Both sides are giving the best side for you. So you have to be a little bit skeptical, and your skepticism goes off as you meet them more often and as you see them for a longer period of time. And,
okay.
And I do believe that price does play some part in your getting comfort with them.
Okay. Then my next question is that why do that at all? Earnings you can track of the company, the performance, everything else is there.
That's what I'm saying. That's what I want to graduate to in the next 2 years, where I get into a system where I can look at a quarterly number and build a thesis on a stock that now it has bottomed out or the earnings have peaked out. I still haven't reached that level. Because I've been used to the access to management for the last 13-14 years. So you do get addicted to it. But it's one more stage that you need to develop. For example, I've never met any IT company, frankly. Now the large ones I've ever met. Because I just don't understand. But I know it's a business which there are other people who understand better than me. I just look at the numbers and buy it from valuation perspective.
So you do both sides of the...
So I can do it for IT, but I can't do it for a manufacturing company or an auto company, because if I've got access, then why wouldn't I do it?
Then the question becomes how much of that access is helpful, or you're doing because you've been doing it for a long time.
See, I think so what it does, it makes you a prisoner from taking the right sell decision, not from the right buy decision. I think so getting too close to management, so I don't have too many mobile numbers of CEOs of companies, nor am I on any of their list to be called for any social functions or weddings, of their offspring or whatever. And I think that's one way to be able to take and some of the lousiest sell decisions that I have taken are when you get too comfortable with the management.
That means selling too late.
Then they are not as it is, will not beat you too often. So you will not get too comfortable with them if you sell it too early. See, if you sell too early, you can always come back and buy.
Is your selling decision primarily on valuation basis?
It should be based on valuation, but I think the valuation is only one side of the story.
Okay, what is the other side?
The way it is in the portfolio of the stock.
So if you think it's cheap but it's 5%, you will have to sell.
If it is cheap, no. If it is cheap and it's 5%, I won't sell. But if it's expensive and 5%, then I would sell. But if it's cheap and it's 5%, it won't be there at 5%.
It won't be there because you start with 1 or 2%. So it has to go up tremendously.
So I generally won't buy a 3%.
What's your starting point?
As small as possible.
What is that?
It depends. So if I just want to keep a 1% position, I'll even start at 10 bips. If I want to keep a 2% position, I'll start at quarter.
Okay, and how do you decide which company deserves what kind of allocation?
What size? Depending on what size of the industry you see, how do you want to look at it, what do you see the liquidity of that stock, whether you can build a reasonable position in it or not. If you know you can't, then you just say, okay, I'll buy only 0.5%, and whatever comes, I'll buy 1,000 shares every day at some price.
Okay, so stock selection, industry selection, selling, portfolio allocation, that part is something you have given a light on. The part which I want more light on is the risk management, and you have been saying that head over shoulders and risk management are the two primary things. How do you define risk? And I know Buffett quote and everybody else, we know that volatility is not risk and all that stuff, but what's your way of looking at risk?
So till 2008, when I first read a Howard Marks memo, my concept of risk equaled volatility. See, I am an average intelligent guy. I have no... and if you've done large part of your life doing mid-caps, you tend to be swayed by that thought process. So why are more mid-cap funds more risky? Because mid-cap funds are more volatile. You have chances of losing capital from time to time, which you don't have in large caps. Because in large caps, theoretically, you don't lose capital.
Theoretically was a good insertion there.
So I think so. One is, for our investors, risk should be liquidity of the portfolio.
Okay.
Especially on the mid and small cap side. And I don't want to have, again, any numbers, but we used to run a mid cap fund in UTI which had 38 days liquidity versus some of our peers which had 300 days liquidity. And it was my foolishness that we could never impress upon our management that this is what we are doing.
Can you just slightly, because I'm not aware of it, how do you calculate that number of days liquidity?
So we take, if you were 20% of the daily volume of a stock, how many days would it take for an entire portfolio? You do it at 25, you do it at 15, you do it at 10, you do an average of all three if you want to be very, very...
So 300 days?
Yeah, there are funds which are at 300 days.
Wow, that's surprising. I'm pretty shocked by that thing actually.
But frankly, it doesn't matter because nobody looks at it.
Okay. Nobody from investing side, you're saying? Investors? Or the fund managers?
People involved who make the fund bigger, whether it's investors, whether it's distributor.
Okay.
So I think you should see that one.
Okay.
Second is from point of view of concentration. How many companies you have in your portfolio where you own more than... So again, to go back to my previous company, we had very idealistic way of doing risk management. Because we think so risk management has a lot of renowned peers say it is not VAR value at risk, but it is generally how liquid your portfolio is. So what percentage of the free float you own? How many such companies should be in your portfolio where you own more than 10% of the free float? If a company has got a float only of 20% and
Yeah.
you have a 3% position in the company,
Yeah.
then it's not a 3% position in the company.
Sure.
It's actually a 6.5%.
Sure.
But if you have a 5% position in a company which is a free float of 65%, you are far better off than the first.
I just missed that question in the previous one. Does that number of days liquidity thing, you said people don't look at it. Is it a number which is available to the investors to make a decision?
Of course it's available. See, if you make an effort, everything is available. The point is, all these things are brought out only when the fund doesn't do well.
Yeah, so that's a very interesting perspective, because like one more thing which I've noticed is in all your investments over the years, there have been no bets which are outsized in terms of you being part of that company, which has been all over through your track record. Even in terms of, and that is why a lot of companies, maybe you must have had a lot of omission mistakes purely out of risk management, wherein you don't go ahead and take up the whole float. So we see a lot of those things happening. And one more thing, from a perspective of a lot of stocks in India, it is easy to buy and it is extremely difficult to sell when the time comes. Because inherently in India, promoter ownership is 50 to 75%. And when you look at it in terms of further institutional holding, you go to the point where the floats are between 10 to 20% across, even in large caps, which is available to be bought. And is that a reason outperformance has been tough or good? How do you take it? As in, the float has been a factor of you can outperform maintenance buying or whatever we call it in the industry.
I think so. It is something which more informed investors and stakeholders in the process have to become more vocal about. So to me, a true skill of a fund manager is when he outperforms with 100 crore or with a 500 crore or with a 1500 crore fund. Because then he has none of those factors available. And then you have to see from where did that outperformance came from. So if it came from buying Opto Circuit when it was going up or buying some other company, then it is not a skill based. So what did Howard Marks say yesterday? If you are aggressive and your timing is right, you don't need too much skill to do well. So how do you differentiate? I think the one way to differentiate is at a certain size, where did your money come from?
Okay. But that's something which I don't think anybody...
Which I can say because now I'm in a small fund. Larger fund house, I would say skill is when you are able to move a larger ship, oil tanker is one. So it's a different perspective. I mean, it's not easy either way. It requires a very different temperament to succeed in each of these two scenarios.
Can you take us through some of the biggest blunders of your life in investing and the key learnings from there?
We'll take the whole day for it. So I think the one is looking back 2010, 2014, not figuring out the building material boom. And I credit Secure single-handedly was the only investor who got it right across every company in that sector. And they would have made multiple times market. So that's a very glaring. I have never bought a housing finance company with any conviction. So I missed that part. So it has taken me a long time to correlate how bond yields move and how housing finance companies react to that.
Some errors of commission, in the sense that you committed the errors rather than omit. I mean, this was a miss. Lots
of. I think one is getting too comfortable with management.
Okay. Have you ever been part of companies which turned out to be fraudulent in nature?
Yeah. So I can't say that I don't have any marks on my armor and only others have. It's just a question of what proportion of your portfolio got impacted.
Which, being a diversified fund, would always be less, isn't it?
No, you could take a bigger position if you had conviction.
So one more perspective in terms of investor appetite, which is increasing across India in terms of, so for a simple example, we being investors, 10 years back or 5 years back, people used to ask what stock to buy. And the culture is changing towards what mutual fund to buy.
I wish some of them would also have a IDFC fund in it. So.
Yeah, so that is slowly the shift which is happening. And say when we look at data, say for example, 100 rupees the total float, 50 is roughly with promoters, another 22 is with the FIIs, foreign institutions, and maybe we are at 12 to 15 for domestic ones. So when do you think will be an inflection point wherein the domestic money over the next few years, if the culture changes, would we be going to a point where the whole market will be fueled by domestic money instead of foreign money over the next decade or maybe 5 years? Or is that cultural change happening? Because you being part of the industry, we are just outsiders on that side.
I think being outsiders, you'll have a better perspective than from somebody who's playing it from inside. So I think there are two things. One is a lot of it depends on where real estate goes. Because real estate is probably half to 60% of all savings of investors in India on an average. So if real estate comes back for whatever reason, then this flow will dry off. It may not go back to where we started, but it will come off from the current gushing levels that we are. B is how long the market is positive. Because unlike an insurance policy, closure of SIP has got no penalty. So I am one of the few guys who's not a big believer that this fountain is a Kamdhenu cow which will keep delivering every year after year. If it doesn't get enough grass, it will stop milk. So one should not take that this is because people are coming in for returns. If they get fearful, if returns for a extended period of time do not satisfy their threshold period, then this tap will get closed. And we don't have any emergence of institutional money yet, which is concrete. Most of it is going into ETFs for whatever reason, which we should not get into. So mutual funds are starved of that flow which should have organically come to us if institutional money, which is pension, provident fund money, was getting invested in the market. But, so from these three factors, I would not say that this is a given that we should take as a status. And B is that a lot of it is also a kind of a circular reference behavior, because foreigners are not selling and Indians are buying, markets are going up, and therefore Indians are putting more money in. But if a period when dollar appreciates and foreigners keep on selling, then Indians will not keep on buying after some point of time, because they will see the behavior and market. So I think so you should not take it that it's a given that irrespective of what happens to FII money, this money will continue to flow in. So I don't think so the equity has arrived as a legit asset class where people will invest in irrespective of what their recent experience is. So nobody till now I know gets up in the morning to say today I have to.
Okay. So what you're saying is the recent experiences have caused the equity to become flavor?
It's not. So it is not the cause of that. So I'm just trying to say that it is not something you should take it as it is a circular reference of other things working rather than this behavior impacting the other.
Sure. Okay, so I'll just close it with some two questions. First, if you have to, and I know it's a difficult thing to do, but let's say if a kid comes to you for guidance and you just have to give him 4-5 key points, summary of your wisdom in 5 points.
I wish I had any wisdom to offer, but then that itself is a lot of people will doubt that. No, I think so. It is something that you will first, again, this is a shameless pitch that if you can't understand it, do it through someone else. So I will not pitch it for mutual funds, but because PMS will not take a 5,000 rupee inflow, then the only alternative available for that poor guy is a mutual fund unless PMS starts taking 5,000 rupee. So A, learn through that experience. B, read to understand why you're doing. C, simplest is to look at companies within the sector in which you work and use that learning to figure out. So don't live in a compartment. So if you are a marketing guy or a advertising or a sales guy, don't view it as that as your only function. Understand how is your company makes a profit, how do your competitors make a profit, and then use that learning to put to good use. So the safest way would be to invest in companies of the sectors in which your company is operating. And usually people, unlike few idiots like me who have been in one sector for 25 years, generally would work in 2 or 3 different sectors in their working life. So you would probably get 2 or 3 sectors to learn from and to build a portfolio from. It's a very simple way, but you have to be open enough to understand the possibilities it offers to you from the inside. But people don't see it that way. People are so used to seeing the wood that they forget there's a forest. And if you are an accountant or if you're a sales guy, you just spend your time doing that rather than understanding how the companies make a profit and how you should profit from it. So either you are trying to seek a tip, which is dangerous, or you are totally blind to and oblivious to how a company operates and makes money. So I think that's a very sensible way to look at things around you and understand. So if you want to follow the great Warren Buffett, that tenet of doing what you understand is probably the one which is the easiest to follow. And you should figure out whether in your Janampatri you are lucky or not. So if you are not, and you have to be lucky to make money. To be at the right place at the right time requires luck as well as hard work, but it requires luck as well.
Okay, and so you spend close to every time you are working, it's investing. What do you do besides investing?
Yeah, so I think I'm trying to, over the last few years, I've been trying to develop other. So I'm a big basketball fan. So I follow San Antonio Spurs. So my life ambition is to go and see every March when they come back to play 12 games at home every March, but I can't do that. But at least some point of time I should do it. My kids are growing up, so just going for just seeing them grow up takes time. Not that I participate in it too much, but just me. And I want to become a writer at some point of time. I want to write blogs.
Wow. You write blogs?
No, seriously, and I'm saying because I believe as a public listed long only fund manager, imitation is something that comes very natural to us. My idea is Grantland, if you had seen that site. So I want to be the Bill Simmons of India. So I want to give views on everything from films to WWE, which I watch shamelessly even now, to basketball to cricket. I think so. In India, the level of writing on cricket is abysmal. Unfortunately, the following and the comments on following cricket is also abysmal, where people write in capital letters and it's so personal. And I compare it to US sports where the writing level may not be great literature, but it's interesting for you to spend that 10 minutes to read that article. I'm not saying we want to write a Jane Austen, Pride and Prejudice.
Sure.
But the 10 minutes or 8 minutes you give to that person to read an article should be something that you enjoy and want to do it again and again.
Sure. But almost every great writer have said that to be a great writer, you have to be a great reader. So, do you read also a lot?
I used to. So I have these spurts. No, I think it happens in spurts. I just don't have the concentration these days. So I'm trying to read the Ramayana, which is one version, which is the exact translation of Valmiki's.
Okay.
So after 1 month, I'm at 330 page out of 700. So I keep it for my flights and try to read it on that. Last time I was trying to read a book, somebody snicked it from the so
okay.
I read a lot of crime.
Okay. Any favorite author?
Yeah, Ian Rankin. So I'm a big fan. I think I am trying to widen my. So I don't read any investment book anymore. I just read memos and
So constant engagement with the markets, but not learning based.
Not based on US.
Any book which have influenced your investment process?
So when I started, I read a book on ratios and analysis, Financial Statement by Leopold Bernstein.
Okay.
Which I shamelessly got Xerox copied.
Okay.
And to me, that taught me more about ratios, which was important as an analyst at that point of time, which I would recommend. See, most of it is very anecdotal, and the Indian markets are a very different stage from what you read and from the
completely
other
agree.
markets. So, yeah, it's great to show your intellectual capacity, but it's very difficult
to implement it.
And in the end, we're all buying metal stocks when they are hot.
Sure. Great. Any question, Naresh?
Sure.
Hello. Thanks a lot, Anoop. Thank you so much.